Hi everyone. Today we have Aviv Zohar from the Hebrew University, and he is going to tell us about correct cryptocurrency pricing. So, thank you, Aviv.
Okay, thanks, Sigal. Hi, everyone, and I'm glad to see people who seek refuge from the U.S. presidential elections in other ways. I work a lot on cryptocurrencies, and when I was asked to give a talk, I thought, what can I give a talk about? I decided to do something which is slightly on the economic side, a little bit with insights from finance. If you're familiar with these results from finance, maybe that part will be trivial for you, but if not, I think it's kind of surprising to see the results. I'm going to talk to you about how we price mining hardware in cryptocurrencies, and don't worry if you don't know what that means, I'll explain everything. And this is joint work with my student Aviv Zohar. So let's get started. So on the agenda, I want to first tell you a little bit about cryptocurrency mining and specific aspects of it. I think there's an interesting economic dynamics that goes on behind the scenes in Bitcoin that a lot of people are not aware of. We're going to talk about the expected income from mining, which is how miners usually, or at least anecdotally, think about how how they should operate and why they should work. And I really want to convey a single message, maybe, that mining should be thought of as an option, and that we should employ option pricing to this area. And I'll explain what option pricing is and how to derive it for mining hardware specifically. And then I'll touch upon the consequences for the security of cryptocurrencies and some of the interesting work that we're doing as follow-ups. So feel free to interrupt me if there are any questions. It's a little hard for me to see the chat because I'm sharing the window, but if you just want to break in to the talk and ask, I'm happy to answer. All right, so let's start with the mandatory chart that always opens talks on Bitcoin. This is Bitcoin's exchange rate. As you can see, it's very volatile, and this, in some sense, is going to be the main point in this talk. It's gone from next to nothing to today around $13,000. But what you'll notice is that it dips and rises, very often and very sharply. So Bitcoin's volatility is going to be an aspect that affects the price of mining hardware quite intensely. So let's talk about Bitcoin mining and what it is. So the Bitcoin system is built on machines that are basically distributed around the world that are called miners. They are computers that basically authorize Bitcoin transactions. What you're seeing in the picture here is a photo from what's known as a Bitcoin mine. Basically, racks and racks of machines stacked together, all of them trying to compute an answer to a cryptographic puzzle that will allow them to add transactions to Bitcoin's ledger. Okay, so they're hard at work, churning away, looking for basically doing hash operations until they luckily might find a block in Bitcoin. So I won't go into the details of how this protocol works and why we need all this mining to secure the currency, but I will say that the more machines that are out there trying to solve this cryptographic puzzle, the more secure Bitcoin is from all sorts of attacks. So now the thing that prompts this huge industry of mining is the mining rewards. Every time we create a Bitcoin block, and this is something that happens every 10 minutes in expectation, we are going to give a reward to miners. And by the way, as miners add more and more machines to this operation, the cryptographic puzzle that controls the block creation adjusts automatically, and it becomes harder and harder to mine blocks. It's a probabilistic computation that has lower probability the more computational work is applied to it, actually.
Question. How do you know how many computers are working on this in the world? Where does this come from? That's private information.
So what we can do is we can look at the difficulty of creating blocks, right? There is a certain number of hash attempts that gets done every second. We don't know how many there are, but a certain fraction of them, a constant fraction of them, gets to build a block. And blocks get published in the network. So we're seeing an estimate of the number of blocks that are, right, by the number of blocks
So you
that
look
are
by the
created.
time elapsed between to create a new block, and
Yes.
if it becomes too short, it means that too many computers out there are out there. That's the way it works.
Yes, exactly. And actually what Bitcoin does is every 2 weeks, they look at the last 2 weeks, the window of past 2 weeks, they see how many blocks were created and the difficulty is adjusted accordingly. Okay, if too many blocks are created, it's made harder.
Okay, thanks.
Okay, so when a miner creates a block, it receives Bitcoins as a reward. And the current amount is 6.25 Bitcoins per block. And approximately, right, and this is for money that's created out of thin air, and approximately 2 or 3 Bitcoins at current activity levels from transaction fees that are included in the block. So you can think of maybe, I don't know, 9 Bitcoins that are awarded to the miner. And if you think about Bitcoin being worth, you know, $13,000 currently, that's almost, right, that's over $100,000 just for creating a block, which is done every 10 minutes. That's the reason there are many machines that are churning away this. Everybody wants a shot at getting $100,000, right? It's a very hefty sum. So now, this saying that's attributed to Mark Twain, I think is very appropriate here. Right? During a gold rush, it's a good time to be in the pick and shovel business. Right? So the pick and shovel business for mining is, in some sense, the business of building the mining machines, not being the gold miner yourself, but being the person building these machines. By the way, Mark Twain himself was a very rich man because of his books, but he was a very bad businessman. He lost a lot of money on pretty much every investment that he did. So later in his life, he said, you know, there are 2 times in a man's life when he should not speculate, and that's when he can't afford it and when he can. So I think he learned the lesson, and think about that when you're thinking about speculating on Bitcoin. Maybe you should take Mark Twain's later advice in life. I don't know, maybe the earlier one. But anyway, so here is the website of one of the companies that's selling these machines that mine Bitcoins. This is from a company called Bitmain. And this is basically their front page. They're offering their latest machines. You can see that you can buy for $1,500 something called an Antminer T19, which gives you a certain number of hash operations per second. So 84 terahash per second. And you can see that all these things are actually sold out. They're only shipping in February of 2021. So this is the pick and shovel business, and they've been outselling picks and shovels. And this is mainly because Bitcoin's price has recently gone up to $13,000, and everybody was rushing to buy this hardware because it's suddenly very profitable. So they ran out of stock. And they have future machines that are even further away. Some are going to be shipping out in March. So before we go on, I want to tell you a little bit that there's a lot of work that's recently been done on mining economics in algorithmic game theory. I'll mention just a handful of papers because we don't have enough time to do more. Maybe the first paper I want to mention is by Eric Budish. It's a working paper that he's been working on, and basically saying that the cost of attacking Bitcoin is not just the cost of buying all the hardware needed to attack it, but really the cost of renting the hardware for a limited period of time, which is significantly lower. So he's pointing out some things about the economics of mining and how it should work. That's an interesting paper if you're looking for something to read. Another recent paper that appeared in EC talks about the energy equilibria in proof of work mining by Amos Fiat, Anna Karlin, Elias Kotsoupias, and Christos Papadimitriou. And I think there's an interesting result there that talk about how miners would reach equilibrium. So usually when we have an efficient producer of goods and an inefficient producer of goods, we end up with pricing, right? That's closer to kind of like the second price. The efficient producer outperforms the inefficient one. Surprisingly, in mining, an inefficient miner, one that pays more for electricity, for example, can coexist with an efficient miner in a Nash equilibrium. And in fact, they show that any Nash equilibrium probably will have at least two participants in the market, and both of them will be making money. So kind of deviating from the classic setting in which the second most efficient producer, has a price that is exactly worth exactly as much as his cost of production. So I think that's interesting to look at that effect. The third paper that I want to mention also from last year in EC is one that talks about the short-term behavior of miners. And it turns out that there's a very nice strategy that can give you more money when you're mining, and that is just to turn off your mining machine for an extended period of time, something like 2 weeks, and then turn it back on again. So if you turn it off and on repeatedly, that's kind of surprising. You end up making more money sometimes than you would if you just mined regularly. So that's a surprising result and very cute, and has some implications, right? If we think the current behavior of miners is not a Nash equilibrium, I think that's rather interesting. So now back to our subject matter, right? So Bitmain, in addition to offering just mining machines, is also offering something which is closer to an investment, right? So think of mining as something that's going to get you Bitcoins. So instead of going through the hassle of buying a machine and it spits out this gold dust in the picture here, and you have to operate it and plug it into the power and find a place to host it, they actually offer one-stop online hosting, where they will actually host a machine for you for some small fee. You buy it, but you are entitled to the rewards, and they will take out costs like electricity and maintenance and so on. So you should really start to think of mining as something that you can buy even without being an operator yourself. There's some supposedly large data center that Bitmain is running this in. So now we are, I think, squarely in the world of finance. You are no longer holding this machine even in your hands. You're running it as an investment. And now what we see as a result is, right, Bitcoin's hash rate, which constantly goes up because of technological improvements and because people are buying more of this hardware. And what I want you to notice is that sometimes this hash rate drops occasionally, right? So miners really turn off their machines because the price of electricity is too expensive for the rewards that they are expected to get. And these drops in hash rate are not accidental. This coincides with a very big price drop in Bitcoin, right? Maybe you can tell me what happened around March of 2020. Does anybody know? Right, obviously this was Black Thursday, where the stock market dropped because of COVID-19, and Bitcoin prices went down as well. And here we have another event, which is called the block reward halving, where Bitcoin's block reward, which is decreased every 4 years, on this day, right, in sometime in May, was dropped by half. Okay, so we see obviously a drop in hash rate, but not half of all mining disappeared on that day, even though profitability went down by a factor of almost 2.
It's interesting it's interesting if I take this graph at face value, that Black Thursday was expected a month before that. It started going down before that.
No.
I understand the reward being halved being an expected event, but Black Thursday was not an expected event. I
think don't take too much on my
okay, so maybe it's the graphics,
the arrow points to where the arrow points, and this is also a smoothed out graph. So there's probably, it takes over a week of averaging, so it might be off by a week as well. But the drop coincides with Black Thursday price drops pretty much. I don't think it predicted it.
No, because for the block reward halving, that's probably was a predictable event, which is okay. But the others might not have been.
Yes.
That's what I'm saying.
That's true. So for the predictable
you could see different behavior in the two, but
right,
here you don't.
The predictable event might have caused you not to buy hardware even earlier, right? To buy less hardware.
Exactly.
But what we see, even for the predictable and for the non-predictable ones, is that people literally shut off machines. Okay, they turn them off and or do something else with them, and we'll talk about that in a second. And there's another drop here that you might be interested in right here at the end. This is just happening in the last few days. This is quite surprising because anecdotally, this relates to the dry season in Sichuan County, right, in China. Okay, so what does the rain in Sichuan have to do with Bitcoin hash rate dropping? Apparently, a lot of the electricity for Bitcoin mining is from dams. And the price of electricity when the wet season is over, the price goes up. And so the miners in Sichuan are actually relocating their miners. They're moving them between places, and there's a significant drop in hash rate because of that. Right? So there's actually people talking about this now on Twitter, that there was this huge drop over several days, and this apparently coincides with this wet season. Okay, so that's interesting.
Every year?
Yeah, so actually this happens every November. There's a small drop every November, and for some reason there's no drop on the other side when they come back for the wet season. There's no matching drop in hash rate. So this is a little bit weird. But apparently, from what we hear, they can pay 4 cents for electricity in the wet season, and maybe it goes up to 5 or 6 cents in the dry season. So this is significant for their cost. Now, if you go online and you want to say, okay, there was a question.
Well, yeah, I'm trying to think what is the incentive of Bitmain. Is it assumed that I have more knowledge of how to operate the machines, of when to operate it? Because they can, of course, operate them themselves and get the money, and not only percentage of it. So what is the incentive of Bitmain in this story?
So Bitmain can, if it holds just mining gear, then this is a different thing than holding dollars or whatever. So you can think of the incentive of Bitmain as as price diversification, right? They do run some mining themselves, but they don't have to do all the mining on their own. They can sell some of the stuff, right, including some of the mining machines, in exchange for dollars, and have somebody else run them.
So they change the risk of changing of price for a constant amount. This is the
right. So but Bitcoin, as we saw, is very volatile, right? So maybe you do want some of your holdings in dollars, and don't forget that Bitmain is a company that needs to pay salaries to employees and needs to buy electricity. So they have a need to convert a lot of money into regular currencies that they can pay people with, right? They're currently unable, I think, to pay with Bitcoins for most of the things that they want. So I think this would explain most of the motivation. So now, if you want to decide if you want to buy one of these and plug it into the wall at your house, you can go online and you can find these things called mining calculators that look at the cost of Bitcoin. By the way, do you guys see my arrow, the arrow of my mouse, if I'm screen sharing? Yeah, Uri says yes. Okay, so you can see the price of Bitcoin currently. You can put in the hash rate of the miner. So maybe the current miner that we're looking at has 84 terahash per second, and there's a power consumption, right? So this is 3,000 and something watts, which is kind of like a space heater. This makes a lot of noise and a lot of heat, so you can heat your house if you wanted. And there's an electricity cost. The number I put here is 4 cents per kilowatt. This is very, very much below what you would get if you paid in the US. the price in the US would be closer to like 12 cents, right? So this is anecdotally what miners are paying. And now this mining calculator basically spits out what they'd expect you to mine and what they expect you to profit, right? So the cost of power for the year, right? You see is around $1,100, which is not negligible compared to the cost of the hardware, right? So 1 year of running this is very close to the hardware cost, gets close. And your profit per month, right? You can see it up here is $118. And this is probably after, you know, a year or so, it's pretty much going to pay for itself. But there are a lot of assumptions behind this calculator. One is that the price of Bitcoin is going to stay the same. And the other is of the hash rate in the network, because we are competing with other miners to get this reward, right? So this is maybe the most naive calculation. But miners are actually making something a little bit less naive. They also usually account for an expected rise in the price of Bitcoin, you know, based on what they believe will happen, and maybe more importantly, an expected rise in the hash rate. And I should also say one more thing. The rewards in Bitcoin are really, really far apart. An Antminer T18, which is this machine we were looking at, is actually at the current difficulty level of the computation is going to generate a block in expectation only once every 30 years of operation, right? So if you're running one of these machines, it's very likely that within its lifetime, it's probably going to break down before 30 years have passed. It's probably not going to give you a single Bitcoin block, okay? But you should remember that the Bitcoin block is currently awarding you about $100,000, and this machine costs maybe $2,000. So what do you do, right? If you wanted to operate one at home, then to lower the risk, miners often join together in pools and they split the rewards between them. So I'm looking at a pool called Ant Pool, which I think is also one of Bitmain's pools. I'm not sure. It's a Chinese pool anyway. And they have a hash rate that they report on here, which is approximately, I think, 10% of the Bitcoin network. And as a result, they win something like 10% of the blocks. And if you are contributing mining power towards this, you're going to get a steady flow of rewards, which is much lower because you're splitting it with all the other miners. So they are reporting things like their luckiness, right? You can see the variance of your rewards. They're expecting to be on 100% luck, basically meaning right, 100% is the number of blocks they expect to win. Sometimes they win a bit more, sometimes a bit less because of how lucky they were with the hash computations. But the variance of rewards here is, you know, significantly better than winning once every 30 years, right? Every day you are getting maybe 20 or plus minus 20% more or less than what you expected. So now we're starting to talk about the cost for miners, right? If you're running a miner and you don't want to just look at the mining calculator, what should you look at, right? So there are all these fixed costs, right? I'm going to look at really two classes of costs. One is the fixed cost, which includes this initial purchase of hardware, but also maybe, you know, you need a warehouse to put it in, you might be insuring it, you might be maintaining it. So these are fixed because I think of them as fixed because you're not paying based on how much you use this machine. Even if it's not plugged into a wall, you need to place it somewhere. You might want to insure it. There are costs that you pay up in advance or you can finance up in advance. And then there are costs that are actually only paid when this machine is running. And maybe the primary one is electricity, but you could also think of, you know, cooling, which might be more electricity. There's maybe extra hardware deterioration because this machine is running. There might be fees that you're paying to the pool that is allowing you to split rewards and so on. So I'm going to take all of these costs and I'm going to just call them electricity for simplicity for the rest of the talk. But really, what I'm talking about is fees that are there when you're running the machine. And now I want to get into the utility of a miner, which is usually described in this way. So we can think of the value of mining at a certain time t. So the notation here is the value of a mining opportunity at time t. And I'm adding another t here for the time I'm evaluating this at. So there's a mining opportunity at time t, evaluated at time t, and there is the value of the currency at currently, right? So CT is the exchange rate from Bitcoins to dollars, for example. So this expression here is basically the value, and what it says is, you're going to get rewards based on your share of the total hash rate. So you have a hash rate H, and the rest of the world has some capital H, which might depend on time. That means you're building some fraction of the blocks. There's the size of the block reward, which for our purposes is going to be mostly fixed. We're not going to think about how it changes. There's the exchange rate of Bitcoin to US dollars, right? So this actually should be BTC over USD and not the other way around. And then there are the costs that basically we're going to quantify as electricity. So the more hash rate you have, of course, this is going to cost more. There's the efficiency of your miner, how many hash computations it does per an amount of electricity that you put in. And then there is the cost of electricity, which I'm also going to think of as fixed for our purposes. Okay, and then you have another option. Right, this term is a max between this expression and 0. One other option is just to not mine, right? So if the cost of electricity is much higher than your rewards, this first term could be negative. You can choose not to mine, and then it's just 0. Okay, so this is fairly simple, although it's a long expression, but not very complicated. And now, right, so mining calculators look at all these information, and if you look at Bitcoin's hash rate, on the left here, there's a chart showing Bitcoin's hash rate and how it grew over the years, and this is in log scale. So you should note that this straight line here, almost straight line, basically implies exponential growth since pretty much 2014. And I haven't checked, but it could be the rate of Moore's law. I think it's a little bit too fast for Moore's law. So it probably has more effects than just hardware getting better. On the other side, you can see the exchange rate, which we already mentioned fluctuates quite a lot. So that's going to be important for us. And indeed, the volatility of Bitcoin is something that you can measure, and it's significantly higher than that of stocks by orders of magnitude, and definitely of other currencies. So I'm not going to go into the numbers, but you can trust me that this is pretty much an order or of magnitude more volatility than other currencies. So now I want to get to the insight of this talk, which is why I gave all this long introduction. And that's mining hardware is actually economically equivalent to a bundle of options. Okay, so when I think of this machine, I'm going to think of a bundle of options. And I want to explain this analogy. And for this, I want to say, well, what's exactly is an option, and what do I mean in the equivalence here. So let's start with what options are. And I'm going to talk about European options specifically, European call options. So an option is basically a contract that allows you to buy some assets. So you can think of a certain stock, maybe an Apple stock or whatever, and you're allowed to buy it at a very specific date, called the exercise date. You're allowed to buy it for a predetermined price, strike price. So for example, I could have a contract saying I'm allowed to buy Apple stock in 1 week for $10. And there's a certain amount that you're allowed to buy, maybe just 1 share. And the option holder can, of course, choose whether he wants to exercise the option or not. If the price of an Apple stock in 1 week is higher than $10, obviously it's worthwhile for me to buy a stock for only $10. But if the price is lower than $10, the option is worth nothing. I could just buy stock on the market for a lower price. So now, when we look at Bitcoin mining hardware, what we have is, instead of a contract, we have a machine, but it's going to still behave the same way. It's going to allow us to obtain Bitcoins at different times through its life. So this is actually a bundle of options and not a single option. But the in order to get these Bitcoins, I have to pay a strike price, which is just a fixed amount of electricity that needs to go into the machine. And just as in options where the option holder might choose not to buy the asset, a miner here can decide to turn off his machine to stop feeding it electricity. And then he doesn't get the Bitcoins, but he doesn't pay the cost, right? So that's exactly the same behavior, and I hope it's clear. If there are any questions, just then let me know here. Okay.
I have a question.
Yeah,
the exercise date is fixed.
Yes.
So you know it, and here you don't know when you're gonna mine the block. So how is it equivalent?
So think about it this way. I actually have for every block, I have I'm going to participate in a mining pool, and the mining pool is going to pay me some money if I participate, right? So for every 10 minutes of mining or so, is equivalent to a single option. So this is why I said the mining hardware is a bundle of options. So you can think of having one European option per time unit, basically. So you hold all of them, and then you decided for every option separately whether you exercise it or not when you reach the certain date. So it's just a bundle of options. The strike price is exactly the same for all these options. It's the same amount of electricity. It's just spread out over different periods of time. Okay? So this is actually a bundle of options.
Aviv, yeah. If I may, one issue is liquidity, which means getting. So if I get my asset, let's say it's in the stock market, it's a stock, I can go and sell it. Here, unless I'm part of a pool which has smoothed out essentially the return, I won't be able to get immediately. I mean, I get an expected return at some which, as you said, has a huge variance. Because it's a huge amount, but it's a very low probability. So unless, of course, I'm part of a big pool, but then I'm not sure if I'm part of the pool, if this moves out, okay, whatever.
So for pools are, there are open pools that everybody can join. And for liquidity, they delay you just for maybe hours or, very little. And you can find pools that have no fees. So Ant pool, for example, that I showed you.
So you are saying that I'm getting the expectation. Essentially, I can get my expectation.
Yeah, or a very low variance of the expectation.
I see. Okay. Okay. In that case, my question is off. Okay.
Okay. So this is specifically why I talked about pools, because if they do allow you to at least remove that volatility out. But of course, when you buy this miner, you bought a bunch of options also for far into the future that you're going to only be able to exercise, in a month, in a year or so, and that volatility, which comes from the price, you don't know the price of Bitcoin in a year, that's going to still affect you, right? And this is what I want to focus on. So now for stock options, there are classical results in finance, namely the Black-Scholes model, that under some assumptions can give you a way to derive the cost of, the price of options. So the assumptions are usually things like, the markets are efficient and I can buy and sell and short if I want, and I can trade without fees, and we'll talk about this assumption in a second. And we know the asset volatilities and we know the asset prices, and maybe the most interesting part of the model is that asset prices in the Black-Scholes model essentially perform a random walk, right? I don't know how the price of Bitcoin, what it will be, but I am assuming it does a random walk, which could be biased, by the way, but it has statistics that I understand. And then if this is all true, there is a very clear price for the option. I'm basically going to walk you through this variant of this result. So Black-Scholes do this with stochastic differential equations. We're going to do what computer scientists do best and use a discrete model because it's very, very simple and very easy to do versus stochastic differential equations. Right, so I'm going to talk about the binomial model, which is this discrete model. And the binomial model basically assumes that time proceeds in discrete rounds. and that the price performs a multiplicative random walk. And I have to say that when you look at the statistics of gains, right, of the exchange rate of Bitcoin, it does look very much like this, right? It has very similar statistics. It's very nice to plot this and see that this assumption is close to what happens. And the assumption is that during each round, I can trade Bitcoins and other assets. I can buy and sell stuff, right? So at time t, I have some exchange rate for my Bitcoins. And the binomial model is very simple with probability p, or probability 1 minus p. One of two events has to happen. At time t plus 1, then the price of Bitcoin, right, exchange rate from Bitcoin to dollar is either going to go up by a factor of capital delta, which is larger than 1, or go down by a factor of small delta, which is smaller than 1. And that continues on for more rounds. And I can have, right, prices that are delta squared C and delta, small delta, big delta C, and so on. And the assumption is that these time steps are very small. You know, I can maybe think of them as 10-minute increments where the price changes very slightly, and over long periods of time, we get behavior that's very, very close to something smooth. Okay, so this is a very, very simple model. And this, of course, goes on and on. So now I want us to look just at two time periods within this model. And we're going to assume that we have a single mining opportunity in this time period, right? And let's talk about how to value it, right? How much it's this opportunity is worth, and then that will help us evaluate our mining hardware, right? So the first thing that we saw is that the value of this mining opportunity at time t, given that we evaluate it at time t, right? If we are already at time t, then we are in one of these two states. We know which state we're in. And this is the utility that we get, right? So every fixed cost is already sunk cost. We can throw it out. And we can basically look at our fraction of the hash rate and the current exchange rate. And we can say, you know, whether, you know, it's 0 or this term. And the question is, you know, what is the value of the mining opportunity when we look at this model and we go back a single turn, right? So at this time, what is the value of the mining opportunity? And I think you might be tempted to just say, you know, it's the expected value, right? We have a probabilistic event, you know, with probability p, we go here, probability 1 minus p, we go here. And so we should take the expectation, and that's it. But this is actually wrong. Okay, so this is maybe the most interesting insight in, I guess, in this result in finance. Using in this model, the expected value is wrong, and I want to show you why it's going to give a bad result. Okay, so the way I'm going to do it is just use a numeric example. I'm going to show you that we're going to compute the expectation, and then I'm going to show you that it's overpricing the mining opportunity, right? So let's look at this scenario where we have two time steps. We have a single mining opportunity at this time, which is going to give us a single Bitcoin, right? We're going to get one Bitcoin if we activate our miner here, and the pool somehow guarantees us that this is what will happen. And the cost of electricity is going to be $250. So I put it up here in this box, right? If we put in $250 worth of electricity, we get a single Bitcoin in time t. And we just don't know what the price of Bitcoin will be. It will either be $800 or $200. Based on the fact that today it is $400, it will either double or halve, and each with probability 50-50, right? So that's our model. So for simplicity, I'm assuming away all sorts of things like the interest rate on borrowing money is, I'm assuming it's 0%, but there's a way to adjust for interest rate as well. So now let's look at the mining opportunity in each case. If Bitcoin is worth $800, and right, then we need to say what's the mining opportunity in this state. It's the max between 800 and minus 250, right? That's the cost of electricity here, and 0. So basically, we gain $550 in this situation if we mine. The mining opportunity, on the other hand, at this state is worth $0, right? So 200 minus 250 means that it's not worthwhile to mine Bitcoins at this situation, and we really want to shut off our machine and get 0. So the other term wins here. And then that means that the expected value, right, is 1/2 times 550 and 1/2 times 0. It's just $275. Okay, so we're going to cut that away and save it for later. And I want to convince you now that $275 is way too much to pay for the opportunity to mine at time t. So I'm going to show you that I can sell you a mining opportunity for $275. I'm going to make a risk-free profit. Regardless of the state of the world, I'm going to be left over with money in my pocket as a seller of mining opportunities for $275. So let's do that. And I want you to follow my portfolio throughout the day. So I'm writing here what I'm holding, all of my obligations and all of my assets. At the start of the day, I'm starting with no cash, no debt, no Bitcoins, and 0 mining opportunities. I have nothing. And then I'm going to try and sell somebody a mining opportunity. Okay, so now I owe a mining opportunity. I have -1 of them. But he gave me $275 of cash. He was paying according to the expected value. And then in the next step, I'm going to do the following trade. I'm first going to borrow $183 and 1/3. Okay, so this magic number. So I have debt. I owe the bank a little bit. I have some more money in my pocket. Okay, so that didn't change much. And then I'm going to use some of this money to buy Bitcoins. And I'm actually going to buy 11 out of 12 of a Bitcoin. Not a whole Bitcoin, but almost. And that's going to cost me, because Bitcoin currently costs around $400, it's going to cost me a little under $400. So I go down from $458 to $91. I have slightly less money, but I have Bitcoins instead. And now this is during time t-1. So now let's see what happens in the next day. Okay, so I carry over my portfolio from the next day, from the previous day. And I want you to notice that now I'm going to talk about the case that we went down. The price of Bitcoin went to $200. So the mining opportunity that I owed actually zeroes out because nobody wants the mining opportunity. They don't want to pay $250 to get $200 worth of Bitcoin. So really I can scratch it off. I owe nothing. Now I want to show you what I do for the rest of the day. I basically just want to cash out all my money. I want to show how much is left. Now the price of Bitcoin went down. So the first thing I'm going to do is sell my 11 over 12 coins. And this is going to give me slightly under $200. So I go up to 275. And I want to repay my debt, right? So I give back money for my debt. And I end up with this $91 in 2/3 in profit. Okay, so I made money actually because price of Bitcoin went down, but I didn't have to give you a Bitcoin for the mining opportunity in exchange for $250. Okay, so this was one case, and I made money. Now I want to show you the other scenario where the price of Bitcoin actually goes up to $800, and I start with the same portfolio that I carried over from the first day. Now, in this scenario, the mining opportunity here is actually going to be realized. Obviously, it's worth it to mine $800 worth of Bitcoin for $250 of electricity. So I want to have enough Bitcoins to pay the guy who bought the mining opportunity from me. So I'm going to buy the remaining Bitcoin to go from 11 over 12 to 1. Right, so this is what I did here, and this cost me some fraction of money. Out of $800, I only needed to buy 12, so that was I think $60-something, $66. So my cash went down, and I now have 1 Bitcoin. And now I tell the guy who bought the mining opportunity, if you want to get the Bitcoin, you have to pay me the electricity cost because that's part of the deal. That's our strike price for this option is that you need to pay me $250 of electricity. So he pays me. And now I'm willing to zero this mining opportunity in exchange for the 1 Bitcoin that I give him. Okay, so I gave him the Bitcoin, and he says, okay, now you don't owe me a mining opportunity. And we did the whole trade. And now you can see that all I have to do is now repay my debt. And I'm again left with the same amount of $91.02, right here. So what basically happened is that in both cases, regardless of the next state, I end up with $91.02. And this is risk-free profit. So it doesn't matter if I'm risk averse or it doesn't, or what the state of the world is. I don't need to do anything. I end up with the same amount of money regardless of what happens. So essentially, this is an arbitrage opportunity. If people are selling these mining opportunities for this price for $275, I always make a profit. And that means that if we think of no arbitrage as a rule that has to happen in the market, the value of the option really is $275 minus this $91.02. It's actually $183, which is less than the expected reward. Okay, so this might be troubling for you if you're used to seeing expected rewards. The thing that might resolve the paradox for you is if you try to think about this model where we thought about the price of Bitcoin either multiplying itself by doubling or halving, and the thing that doesn't make sense exactly here is if the price of Bitcoin tomorrow is going to be either 800 or 200, with 50-50 odds, right? The expected price of Bitcoin tomorrow is $500. So why are we using a price of $400 today if tomorrow it's going to be $500 and there's no interest rate in the economy, right? The reason is that this somehow hides some risk attitude of people who are trading Bitcoins, right? This is valued less than the expected reward tomorrow because they are somewhat risk averse. And what this trickery that Black and Scholes did basically is to show you that you can, without explicitly thinking about the risk, you can factor it out and have a risk-free portfolio. That's a very, very, very nice result in coming from finance.
So Aviv, just to make sure, this is a standard binary model, Sharp and Cox, whoever. I mean, there is nothing here. Having to
nothing new here. So I just took it.
Okay, no, there is nothing even here.
Yeah, we just did minor adjustment. We put in the hash rate over time, and we put in statistics.
So just the way you evaluate it, it's just a value function. But other than that, it's a straightforward. It's a standard binary model.
Exactly. Right. So there's nothing new here for people from finance. Exactly.
Okay. Just to make sure.
Right. So now this is exactly the generalization that comes from the standard binary models. You can basically hold an opportunity and a short on a certain amount of coins that we can compute, and that would give you always a way to assess a risk-free portfolio for the asset between time t-1 and time t. So that's a generalization of the example that I just showed you. You can short a certain amount of coins and hold the mining opportunity, and they basically cancel out. Okay, that's what I basically showed. And we just made an adjustment for Bitcoin. Right, and similarly, just as we can go back a single turn, right, we can remember that we have maybe more turns in our model, and we can compute from time t+2 the value of options at time t+2 as they are evaluated at time t+1, and then we can have different states, and again we can backtrack one more step and think of the option at t+2 at time t instead of just time t+1. So you can go back in time, and that's the standard way that it's done in finance.
If I may add one thing that may help people, if you use the word hedging, the way these things work is through hedging, which means that you are building a portfolio such that no matter what the state of the world will be tomorrow, you are going to have exactly the same amount, which also says that the probabilities of half-half are immaterial.
Exactly. So
no matter what probabilities you put there, whether half-half or anything else, the answer will be the same because you are guaranteeing for sure, no matter what will happen tomorrow, that you are going to have 91 2/3 or whatever dollars.
Right.
And that's really important insight.
Formulas is delta and delta, right? The increment.
Yeah, it's a size and not the probabilities.
Yes. So basically, in some sense, you can say that the larger delta, capital delta is in a small delta means more volatility. The prices are going to be oscillating much more violently. And that's really what matters. So now you can derive a closed form formula for the binomial model here, and we have our own variant with with the hash rates inside it and so on. And you can have an algorithm, and the algorithm is useful for when you start to deviate from the model in ways that you cannot later derive a closed form formula. And this is actually some of the stuff that we're doing now. So you can basically back propagate the value of this mining opportunity at the future to a time in the past, and the algorithm basically just composes these risk-free portfolios and does the calculation for you. Or you could, for the simple case that I showed, there's just a closed form formula that you can, there's a summation that you can just compute. And now we went out and did and started to compare to data, right? So we went back and you could go on Amazon. This is actually a screenshot from Amazon. You can find things that are being sold, like the Antminer S9. This is actually being sold even today. You can buy it used for $120. And this is a machine that was pretty much dominated the ASIC market for maybe a year and a half. And we can look at historical prices on Amazon as a proxy to what people were valuing these mining machines. And so what you're seeing in this graph is over a period of a couple of years, you're seeing, according to Bitcoin stats that we can look up, right? We know the estimated hash rate in the past. We know the exchange rate of Bitcoin and so on. And we can look at what the expected prices would have been. So that's the brown line at the top here. It's very high. We can see the price on Amazon of a mining machine. Well, this is specifically the S9, which is slightly lower. And you can see our estimates for what they should have been based on volatility and other estimates if we just take the binomial model. And I think one of the things you can see is that usually we price these ASICs lower than miners have. But they did not use the full expected price, right? They did go a bit lower. I guess the market kind of was signaling to go lower, but still not all the way down. So now I want to tell you a little bit about the implications for mining, and this is maybe going to be very clear to Sergio and other people who know the finance literature well enough. One thing is that when you're talking about option prices, volatility, when there's more volatility, the option is worth more money, not less, even if people are risk averse, right? The market is risk averse about the currency, right? But options actually increase in value if you do the math, which is kind of surprising, right? If you think about somebody says, I'm going to promise you coins sometimes in the future, which seems to be like what mining machines are doing, then coins far in the future are going to be worth a very unknown amount. I don't have certainty. So if I'm risk averse, I should think about buying coins for far into the future as something very, very bad, or I would underprice them. But because you have the option not to buy the coin, right? You can decide not to invest electricity in the future. That changes things. And actually, when Bitcoin is more volatile, then the mining hardware becomes more valuable. And basically, the intuition behind this is that if the value of Bitcoin goes up sharply, you can make unbounded rewards. There's no limit to how much money you can make as long as Bitcoin's exchange rate goes high enough. But even if Bitcoin goes to zero, your loss is limited, is bounded by zero. You can decide not to activate the mining machine. You may have paid for the hardware but not used it eventually. So you have bounded losses but unbounded rewards as volatility increases. So what you can see here is Bitcoin's volatility. This is the peak volatility that we measured, the annual volatility, peak annual volatility, and you can see that depending on when you bought your ASIC, having lower volatility would have meant that your machine would be worth much less compared to high volatility times. So miners should be thinking about whether Bitcoin is going to be more volatile or less. The second implication that comes from the Black-Scholes model.
So we have just a few more minutes, okay?
Yeah.
Okay.
The second implication that came from the Black-Scholes models is that whenever you're running, right, what we were doing here, we were building a portfolio that basically imitated the rewards from holding a Bitcoin miner, right? So this canceled out with the mining opportunity that we owed. So we could just hold the debt and BTC here in this circle, and they would essentially give you the exact same reward that the mining opportunity would. And we went back to historical prices, and we thought about what would happen when we started trading in this manner. And what you could see here is in green, you can see the cost of an ASIC on Amazon. You can see the cost of our imitating portfolio here in red. So we could buy an imitating portfolio for less money than the ASIC would cost. And here in blue, you could see the revenue of the ASIC would have made if you ran it according to historical data. So we can estimate pretty well. And this is a lower bound estimate because we're only thinking of the price of hardware and electricity, and there are all the other costs of housing the ASIC and so on. On the other hand, you can see the revenue from our imitating portfolio is higher. So this mismatch actually means that that our model is not precise for Bitcoin, because we would have expected the reward to be exactly the same as the reward for the ASIC. The reason that the reward is actually higher than the reward for ASICs is that when you look and you try to project the growth of the hash rate for the future, our model actually predicts a slower growth of the hash rate. So in some sense, people are buying more ASICs than we expected them to, and they're doing it for a higher price than we expected them to. So the mismatch basically showed that if they would have been trading coins, they would have made more money and paid less to begin with to purchase this position in the market. Right. So this basically taps into an age-old question in Bitcoin of whether you should buy Bitcoins or ASICs, and in some sense, what this application of finance tells us is that as trading fees decrease, right, you can trade more freely, and Bitcoin volatility decreases, then imitating portfolios actually are going to get closer and closer to ASIC values. So you could just buy Bitcoins and not ASICs, and not even trade if the volatility goes down, right? So that would mean that they would be equivalent in some sense. So that has implication for the security of Bitcoin. If nobody is buying ASICs, then the currency is less secure. Another thing that we saw is late delivery of hardware. You can see that if you are delayed in delivering hardware, 60 days, 90 days, like ASICs are being sold today, you are losing a huge % of the value, both because of the uncertainty about the price of Bitcoin in the future and in increases in hash rate. Right? So you're losing a lot of money from not activating your ASIC directly now. There was a question by someone? Okay. Yeah.
I have a question.
Yeah.
You made the nice point that in fact you're not buying one option, but you're buying a bundle of options that you can operate at many times in the future. Now, have I missed something? Are you taking this into account in your analysis?
Yeah, it is taken into account throughout the analysis.
I see. So even relative to the fact that it's a bundle, it's still overpriced.
Yes. So the bundle is limited in size. However, it seems like the machine would live, might live forever. But really,
no, of course not forever.
increase in hash rate, because your competing hash rate actually increases exponentially. If you take that into account, you're going to only make money in the next year or two, and then it's pretty much going to go to zero.
Yeah, but still, a year or two is a lot of. It's not one period; it's many. But still, even then, it's still overpriced. Okay.
Yeah, so we will say that it did cover the costs, right? So one thing that we saw is that this blue line is higher than the green line, so they did make money, but they actually could have made more, right? So the difference between the red and the orange line is what we would have made just trading the Bitcoins, as according to the imitating portfolio, which this gap shouldn't have existed, and part of it is because we didn't do a good enough job maybe with the model, but part of it is because they're overpricing ASICs and buying too many.
They should have run their ASICs in computing Black-Scholes prices rather than hashing.
Sorry?
They should have run their computers in computing
Black-Scholes prices
rather than hashing.
Definitely. And now this would explain to you, by the way, I think the question from the beginning of the talk, why is Bitmain selling ASICs? Maybe if the ASIC people are willing to buy them for too much money, it's better to sell them than to actually run them. So people may have a mysterious belief in the value of ASICs that is irrational compared to some of these models. Okay, so I'm going to, I think our time ran out. So I won't talk about a lot of the ongoing work that we have to continue. One of the things that we wanted to do, maybe I'll mention, is to endogenize the hash rate growth. So part of the model assumes that the rest of the world buys ASICs, without any influence by the price, which of course is completely wrong. When the price of Bitcoin goes up, people want to buy more ASICs. So we actually have a model that now refines this, and this is starts to deviate from the classic results in finance, where the price goes up, you want to buy more ASICs, and so that you should take that into account when you look at the binomial model. If the state is going to go up, people are going to, you're not just going to make more money, but also the competition against you is going to grow. And then there is a path dependence that doesn't exist in the Black-Scholes model. If you get to a certain price and you've gotten there by going up and then down, it's very different from getting to the same point but going down and then up. Because on the way, people bought fewer ASICs if the price went down and then up. So you are history dependent in a way that Black-Scholes isn't. So this is some of the work we are now doing. And there's a lot more stuff that we didn't cover, like there's costs to turning on and off your ASICs. It's not something that you can just do immediately. And there are people that are actually building mining machines that can be programmatically switched to a lower state of operation. So they would consume less power and maybe produce less hashes, but not in a linear way, because machines, when you slow them down, consume less electricity. For example, cooling requirements go down. So people are thinking of mining economics, and that influences how they build mining machines. So I'll stop here, and I'll thank you all for listening and for being such a great audience. Thanks.
So thank you, Aviv.